Greetings from all at 5-Star Metals and welcome to this month's Ty's Take. My name is Ty Chapman, the president of 5-Star Metals. I'm going to go over a few things that I found interesting this month that affect your business and will hopefully give you some insight and help you plan for future events and plan your business accordingly. The first thing that happened was the United States government decided not to renew sanctions waivers for those countries buying oil from Iran. Now, while I find this interesting, I personally don't find it unexpected. However, markets seem to be quite a bit surprised. And I'm going to show you a chart right now of the backwardation in the futures curve. And Brent crude is now entered into backwardation in excess of $3 a barrel, or I should say did shortly after the sanctions waivers were done away with. And that's in the 80th percentile. So that's a lot of backwardation and shows a fundamental difference between how the markets view oil markets and how the White House, the State Department, and the EIA does. According to the EIA and the White House, markets are well supplied with oil, and doing away with these sanctions should have little to no impact on the price of oil. Saudi Arabia, interestingly, and the United Arab Emirates joined the United States and promised to increase oil production as necessary to offset any loss from Iran. But there's a fundamental difference between what the government thinks, what OPEC thinks, and what traders think, and I think that, to me, is more interesting than the actual sanctions waivers not being extended. Another interesting thing that happened this month, as some of you or a lot of you probably noticed, that Chevron made a bid for Anadarko Petroleum in an effort to purchase the outstanding shares of Anadarko. They offered $65 a share. That happened a couple of weeks ago, and then late this week, Occidental Petroleum upped the ante and offered $76 a share. But what I think we're seeing that interests me more is, and I talk about it in the article this month, are we about to see a wave of consolidation in the shale industry? And I'm gonna tell you that I think that's about to happen because shale industries have shale oil has its problems. The first chart I'm showing you is their profitability. The simple fact of the matter is shale oil has not been profitable, and investors are getting tired of that. In the article this month about shale industry consolidation, I take you through some of the issues facing shale, some of the opportunities, what I think the oil companies of the future are going to look like. But suffice it to say, shale's not turning a profit, and they have a bigger problem. So the next chart I'm showing you shows you the production per well. We've talked about the parent-child relationship before. All these shale companies bet big on the fact that they could drill wells closer to an original well and still produce the same amount of oil. Frankly, that hasn't happened. New wells that are being drilled are producing substantially less oil than wells that were drilled in 2013 and a few years after that. 2018 wells are producing cumulatively, they're producing a lot at first, but then they're petering out. So EOG's found this problem, and several other companies have reported this. We've been talking about this substantially, but one of the things I think that makes an interesting case for is how much equipment is going to be needed just to maintain current production. How much crude production will we see go offline in the next year or two in the United States simply because this type of drilling is not sustainable, it's not working. And so I think that could speak well for our industry as an oilfield services company. I think that could actually help your business. But I actually think it's going to create a major problem for Shell because Shell's been running on a treadmill. They haven't been producing a profit even when times are good. Investors are getting tired and they're saying, listen, you've got to stop counting barrels. You've got to start counting money. And so that's going to have some interesting impacts as we go forward. And I suspect that what you'll see is a lot of shale oil companies getting acquired because bigger oil companies were far behind the eight ball in their shale production, and they need a short cycle component. The next thing I want to talk about is earnings. And a lot of us saw a decrease in our business over the last few months. And I think the CEO of NOV described it best. So I'm going to let you listen to what he said during his earnings call. Let's take a listen.
Late last year, we witnessed one of the sharpest and fastest declines in oil price on record as WTI fell to $45 per barrel, along with rising demands from investors that oil companies exhibit more capital discipline and austerity. Oil companies responded by signaling their plans to trim CapEx and reduce activity as we enter 2019. NOV's largest customers, the oilfield service companies that execute well construction plans for these oil companies, in trying to divine what the new year would hold all seemed to decide that discretion is the better part of valor, and they threw the brakes on their spending for the tools that they buy from NOV. After a very quiet start to the year, we saw orders begin to flow again in late February and March to support activity. Book-to-bills in excess of 1 for Completion and Production Solutions, which booked half its orders in March. Rig Technologies and Drill Pipe provide a much more constructive backdrop for the remainder of the year, and we expect our second quarter results to be significantly improved.
So I think that kind of fairly and accurately summarizes what a lot of us saw. I know that at 5-star, our phones kind of didn't necessarily go quiet, but certainly slowed down a little bit over the past couple of months. But we're starting to see that come back around. And so all of that seems to be falling in line with industry. So if your business seemed to have gone down a little bit, I would say don't worry too much about that. It seems to be cyclical, and you can only control what you can control. And if there's a downturn in the market, you simply can't control that. So the next thing I want to listen to is the CEO of Schlumberger. One of the biggest debates we've had at 5-star, and I think a lot of you have talked about, because I've talked about it with a lot of you, both our customers and our suppliers, is what is the new normal? I don't personally think we're going to see 2008 again. I don't even know that we're going to see 2014 again or 2013 again. So what does the new normal look like? And Paul Kilsgrad, the CEO of Schlumberger, was asked that question. What happens if oil stays at 65 to 70 a barrel? Here's his answer.
I'm really curious about how you see long-term growth shaping up. So if we paint a scenario and, take a look at the forward curve and say crude stays, around the $65 to $70 level on Brent, how many years of reasonable growth, call it mid-single digit, can be reasonably expected as reinvestment rates normalize and assuming no major change in crude?
Well, I think if you look at where investment levels were back in the period 2010 to 2014, obviously internationally now we are still almost around half of those investment levels. And if you were to say that the new normal is somewhere in between where we are and where we used to be, you still need multiple years of not even single digit, but probably double digit growth in order to get back to even the halfway point between investment levels in 2014 and investment levels as of today. So we still see a fairly decent runway for increased international investments, and you also see that the need for this in the production declines that we are now seeing in the mature production base internationally.
So I personally agree with Mr. Kilsgrad. I think that overall, we can't really expect to see the kind of thing years that we saw in 2008, but there's been substantial underinvestment in the oil field industry, and I think all of that is going to lead and will sustain the future. That investment is going to have to eventually be made. Everybody has to pay the piper, and eventually, unless oil production starts coming offline, that piper is going to have to be paid, and it's been coming offline. So as countries, as national oil companies, as private oil companies want to increase their production base, they're eventually going to have to make the decision to go ahead and invest. So I think overall, we should expect some continuing rebound, but the length, the duration, and where that number eventually goes, I don't know. Now, he seems to suggest it's somewhere between the great year and the worst year, and that's the new norm. And I don't know that he even knows whether that's right or wrong, but I suspect that that's pretty close to what we should see in the future. So in closing, I maintain my prior guidance, the guidance I gave you in December, the guidance I repeated in January. The one caveat is I don't think we'll see much more of a slackening in business to the extent that we see one at all. And in fact, I think that in the last half of the year, we could see an uptick. I think a lot of people, and I say people, a lot of oil companies are waiting to see what happens with OPEC and how much they deplete inventories. So I think the $1 million question is, how much of the Iranian and Venezuelan production is OPEC going to make up versus how much are they going to let it further deplete the inventory? Because I think one thing that people are cautious about is they didn't let enough safety margin happen last time. And by safety margin, I mean safety margin in terms of inventory depletion, so that if oil or substantial crude production started occurring, there would be enough of a low in inventory to absorb that crude without creating a huge risk of markets being oversupplied with oil having no place to go. So as always, Thank you for your business. Thank you for your friendship. Thank you for your support. Let us know if there's anything we can do for you. Take care.